All right, now that spring break is over, I thought, hey, we'll go ahead and do a video. We got back here late last night on Friday night, so we'll do a video for the whole week as we head into a new week. Next week, of course, I'll be here on Monday, just like normal. But I decided we'll do a quick video here over the weekend, just kind of give you my take on what happened over this past week. I didn't spend a lot of time. I was at the Central Coast in California, which it's kind of hard to spend too much time at a computer when you're such a beautiful area of the country. But we had a great time there in Monterey. It would have been better if the road hadn't washed out like the day before we got there. We could have spent a little bit more time along that Big Sur, but we did go down to Cambria, San Simeon, in that area, down at the bottom of that Highway 1, Morro Bay. Really, really pretty part of the country. Enjoyed our time over this past week. But now we're back to work. Spring break is over. Before and kind of going into the summer. We'll see if we end up getting our normal period of volatility. It seems like we started a little bit of volatility here over the week. What did that start do? What signals did it produce? I'm going to break down, what signals it's producing, especially on the Dow Jones Industrial Average, where it seems to be picking up the pace of volatility a little bit more than the other indexes. We'll break down some of these charts we've been watching, some of the things we talked about on that before I left. We'll talk about how those came to pass over this past week, especially with volatility, that compression of volatility starting to expand out a little bit, right? It really hasn't broken out yet. We'll talk about the stages it's going to take for that weakness to occur. And then we'll take a look at what the rotation that's going on in the market, what's driving a lot of this weakness here, in these that three-headed monster that I've referred to before in those major asset classes. And then we'll talk about our trade idea of the day of a stock that's breaking down itself. Post a really good earnings report, starting to go in the other direction now. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, April the 5th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video, where I review all the trades that we've done in prior Outlook videos and see whether we should stay in them or not. We also put on the current day's trade before the market closes. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. And again, thank you there for the comments. Really appreciate that. Again, the more you do that, it helps get our content out to all of our followers on those platforms. We got up to 80 likes, which is a big deal. Our goal is always 100. So we're getting closer. We've been in the 60s. We had a few in the 70s. Now we're up to 80. So thank you again to those who like that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off and take a look at the S&P 500 with the market forecast indicator. As you can see, we didn't get a bull tag because the pink shading and the yellow line occurred on separate days. But we did close below the 30-day moving average for the first time since way back here this past week, since we got the bear tag. We closed above it back in November of 2023. And obviously, we bounced up today, but it didn't keep the intermediate. The intermediate line did cross below market sentiment on Thursday, and then even with the rally on Friday, it still continued lower down out of the reversal zone. So this is the second time it's been out of the reversal zone. It did get out there at the very beginning of the calendar year. We are still less than 1% below. So if you kind of take a look at where we're at currently above the moving average, it's still lower than a good chunk. There's only been a couple of times we've actually been lower than this. So this, despite the bounce, we're still pretty close to the 30-day moving average compared to past times. The momentum line did drop to an extreme low again. Last time it did, it jumped right back up to an extreme high in one day, right? It went from boom, boom, from extreme low to extreme high in a single day, which obviously doesn't happen very often. You can see it didn't happen this time because this time this extreme low was produced with really small ranges that were also slightly lower. This extreme low was produced by a sizable drop, right? When that's the type of extreme low that tends to be more bearish. You can see like this extreme low was produced by smaller ranges. This extreme low over here was produced by smaller ranges. this extreme low was produced by a sizable drop. And so we weren't able to bounce back up as strongly. This extreme low was produced by a pretty decent drop. Remember, it's still not a 2% drop, but smaller ranges still. And here was one singular drop, sizable drop, and then we bounced up. So here we've actually been down quite a bit, and actually got a bull close to a bull tag. The idea of a bull tag is there, obviously, and yet we're bouncing up. In fact, we're actually getting a higher near-term low point this go around than what we had over here. So suggesting that this could be a bullish near-term divergence pattern, where we've gone a lot lower than what the near-term line suggests we should have, and we would anticipate a bounce back up. Of course, anytime the near-term line bounces and drops into bearish territory, the precedent has been for the last so many months that will bounce back up, and until that the precedent will change, like that precedent will break at some point in time. But until it breaks, you have to assume that it will follow precedent until it doesn't. And so again, you can see the momentum line did bounce. The near-term line also did bounce slightly, not significantly. So we're it's not like we're out of the woods here, but we kind of need, especially we'd prefer to have that momentum line get back into the reversal zone, making it likely that the near-term line will also get into the reversal zone. It hasn't been staying in the reversal zone for very long. And it hasn't been staying in bullish territory for very long. I mean, look at all these forays into bullish territory. They've all been very brief, instead of like these longer forays where we get up and we don't get into bearish levels for a good chunk of time. And same thing here. We spent a good chunk of time without getting the bearish levels. Same thing over here. We spent a good chunk of time without getting the bearish levels. That has not been the case lately. We've been just up and down, up and down, up and down, up and down, going from overbought conditions to bearish levels, but never really to significantly to strongly bearish levels. Only, again, the time at the very beginning of the calendar year, and then a week ago when we were getting the very small ranges, and then this past week we dipped our toe underneath there. Let's take a look at the NASDAQ 100. And you can see the NASDAQ 100 did get a bull tag. Again, but this is the third bull tag on this current intermediate run. Remember, bull tags can either be continuation patterns or they can be the beginning of an intermediate decline, right? It's one or the other. It can be they're kind of pivotal patterns that can mark pretty decent moves in one direction or the other. Now, granted, when you're only a month or so into an intermediate run, you get a bull tag, it can spark a new leg higher. The problem with these bull tags now, even if they are bounces like this last one was, it's kind of hard to get going for a strong new leg higher because of how mature the intermediate run already is. And the more mature it gets, the less likely the bull tag will be a continuation pattern. And if it is, it won't be for very long. And the more likely the bull tag will be the beginning stages of an intermediate decline. So we do have pink shading. We are below the intermediate line. The intermediate line is below market sentiment. The near-term line obviously did cross below the intermediate line, and has been below it now for this entire time. Remember the S&P, that's not an issue because the near-term line didn't cross below the intermediate line while it was between reversal zones. That was the case for the NASDAQ. The NASDAQ, the intermediate line was between the reversal zones when the near-term line crossed below it, and it's been below it ever since. So now you kind of have the bearish pattern of the near-term line being below the intermediate line is falling between the reversal zones, and the intermediate line is below market sentiment, which also happens to be falling between the reversal zones now that it's crossed back below the 80th percentile. So you can kind of get an idea of the waning bullish strength that we have in this current trend. Looking at the Dow Jones Industrial Average, you can see not only do we not have the dark green shading and the green line, we actually have dark pink shading and a red line. So we have the beginning stages of an intermediate decline. We did drop on Thursday pretty significantly below 1.25% below. So it's not strong. The intermediate line is below falling market sentiment line. It is now in the lower half for the first time. So that's why we got the dark pink shading. It's in the lower half of the chart for the first time since back over here. Of course, the short-term sentiment is pretty strongly bearish with that decline, and we'll see how that continues. And then finally, your Russell 2000. When you look at your Russell 2000, it also, again, crossed below market sentiment between the reversal zones, and the near-term line is below it down to bearish levels. And we did get a bull tag here too. And again, The last bull tag sparked a new rally higher, but will it be a bull tag like this? It doesn't. So we'll see. We have to bounce off of this, right? We can't just hover around this bull tag low. We have to, on the day that you get the bull tag, you need to get back above that high point. And once you get back above the high point of the day you get the bull tag, then there's a good chance that we're trending back up to the upside. So there's the high point of the day we got the bull tag. Essentially the day we crossed below the 30-day moving average. When it's a smaller range, kind of like this one here, when it's a smaller range, it's a lot easier to get above that high point. And as you can see, we did a couple days later. Not so easy when it's a bigger range like we saw on Thursday. So we'll see how that plays into it. Again, it appears that we are more likely to that this bull tag will be more likely, to actually produce an intermediate decline here. Let's go back to the S&P and look at its weekly market forecast before we look at this other weekly charts that we do. And you can see one of the first down weeks, one of the only down weeks we've had in a while. We've had 3 out of the last 5 weeks have been down weeks, so we've been over the 5 weeks, still higher. You can see the near-term line is coming down out of the reversal zone. The intermediate line is still well above market sentiment, so it's very strongly bullish. Still in the 87th percentile, though we're not getting green dots anymore. So we still haven't really created, a little bit of a bearish divergence, but we still haven't really created a strong bearish pattern yet on this. If you look at the Russell 2000, which had a little bit more of a bearish week, the near momentum line did fall a little bit further. And then your Dow Jones Industrial Average obviously had more of a bearish week as well, showing very similar pattern to what we saw with the Russell 2000. Let's take a look now at the other weekly chart here for the S&P, and you can see the transition candle that we just got. So this is our first transition candle that we have, since back here at the very beginning of the year. Remember, when the transition candles are actually strong bearish candles, then they tend to transition right to a new bearish trend. We didn't, kind of was in January there, and it kind of is here. It is more of a transition this time than what we saw before. So we'll see how this plays out over this next week. We did get a lower close. We did get a lower high point as well. So this is truly a transition candle, an upper and a lower shadow. There's an expectation that we could transition to a new bearish move. You can see the same thing 3 out of the past 4, but really 4 out of the past 5 weeks. And if you go out to here, 5 of the past 7 have been transition candles for the NASDAQ, as you've been in the 94th percentile of how big this gap is. And again, a lot of these transitions haven't been too bearish, and this week really wasn't too bearish either. So keep that in mind. Looking at the Russell 2000s, this was a bearish candle for the week, and so that makes this transition more significant. See, these last 2 right here, these 2 weeks are also transitions, and you can see a little bearish there, but not really. And then this one's obviously a lot stronger bearish, so more potential for this to turn, this one to actually turn into a transition candle. And the same thing with your Dow Jones Industrial Average. Again, a pretty strong bearish week. When you look at the Hakinyasha candle here, a transition candle. That is a strong bearish candle. So again, likely that we might transition to some bearish candles now. That is the expectation, especially considering, again, how strong the gap is between the 10 and 40 week exponential moving averages. If you look at the whole, the weekly, you can see the daily chart for the whole. We are now below the 200-day whole on a Hakinyasha close. So that's significant. Again, the last time you broke below the 200-day close, we were starting an intermediate decline there. You have a red daily hull that we are below. Remember, we are below the 200-day hull there, so that MACD is finally below 0. And you have some bearish candles here. Again, transition candles. They're not strong bearish yet. The parabolic SAR has flipped to the upside. There's your Dow Jones, a lot more bearish, right? So you can see a much more significant decline. Your IWM, same thing, similar to a lot more bearish there as well. So things are looking more bearish on these. If you look at their weekly versions, there's diamonds. The diamonds did flip the parabolic SAR up on the weekly. So that's the first one. So you saw IWM, parabolic star still below it with that transition candle. SPY also has a transition with that parabolic star, and same thing with Qs. The PPO is below the moving average, still well above the 200 week, but your diamond so far is the first one that has flipped that parabolic star. Still hasn't turned red on the 20 week, but you can see how things are rotating to the downside on the daily charts, and starting to move lower on the weekly charts as well. If you look at the moving averages here, you can see again we had closed below the 30-day moving average for the first time in a long time, and for that matter closed below the 17-day moving average for the first time since the beginning of the year, and a lot further below the 17 than what we did even then. So a lot more significant. The MACD, though, is still positive. It's below its moving average, but it's still positive, so the 8-day is still above the 17-day. In fact, we closed back above the 8-day on the bounce on Friday. It kind of goes to show just how close some of these things are, even with the bigger ranges that we've gotten over the past couple of days. Well above the value area. Big gap between these moving averages. If you look at the diamonds, which has been the most bearish, it broke the 50 and still is below the 50. The MACD has gone negative. Stochastics has gone in the bearish territory with some above average volume. So again, you can see how bearish the Dow has been compared to like the S&P or the NASDAQ, and then there's our IWM still kind of, got a little bit more support than like say, but the diamonds, remember, has such a horrible margin of safety, big gap here between the 50 and 200-day moving averages. If you look at some of these other oscillators, your S&P, the DMI is not so strongly bullish anymore. In fact, your positive indicators dropped below 25 for the first time again since the beginning of the year. This time, though, the negative, unlike then, the negative indicator was not above 25. This time it is above 25. So a little bit more bearish of a pattern. Again, looking at the diamonds, which has been the most bearish index, you actually got above 30 on the DMI on Thursday, still above 25 easily, and your positive has broken below 25 again. It's not the first time it's broken below 25, but it's the first time it's done it with the negative indicator so high. If you take a look at the RSI and the CCI for the S&P, we did dip below 50 for the first time on Thursday in a long time. Though that doesn't mean anything until you break below 40, so you're still doesn't turn red. Like, it turns red once you turn 50, but that move below 50 has to be confirmed with a break below 40 without getting above 60 first. And so, obviously not confirmed there, and you're below 0 on the CCI, but you're definitely not below the minus 150 or minus 200 levels that would suggest that we are turning bearish there. And especially, we don't turn, we don't turn, like we turn off the green shading here when we turn off the green shading when the weekly gets below minus 100, and obviously we're nowhere near that. It is below positive 100, and your CCI, your weekly RSI, excuse me, was at 78. It's still above 70. It's still at 74 despite the bearishness. Obviously, that's not the case for the Dow Jones Industrial Average. You are now below 70 after a big break in a big being above 75 previously. So things are turning a little south in some of these indicators here. Your Ichimoku cloud, still strongly bullish. You're finally back below this 23 level. In fact, you're below you got right down to 22 here, but still a very mature trend. And you're still above the blue line. In fact, you got above the green line over there. You still have a positive rate of change. Your diamonds have a negative rate of change now. You've lost your strong bullish trend. You are well below the blue line, which again, that's the first stage, filling in the gap to the cloud. Then you fill in the cloud, and then you break below the cloud. So that's the move we've made so far. So you see how things have definitely turned on the Dow Jones Industrial Average to the downside. Your on the Bollinger Bands, you did get down to the 30th percentile of the bandwidth on Thursday. You're back in the upper half of the bandwidth at least. Remember, it's a very small bandwidth. It's inside the Keltner channels with the red dots there. Again, looking at the diamonds, you got to the lowest quartile of the bandwidth on Thursday. You're still in the lower half, still in actually the lower third, and the bands themselves are very close to coming back out of the Keltner. They're inside the Keltner channels, but they're close to coming back out of them. So you see how things are moving in that regard. Looking at the 4-week range, you notice again The last high point we got was Thursday before the market, before the Easter Good Friday holiday, and then this past week we didn't get a single high point. So your rune indicator is almost below 70. We'll be there after one more day, and then your low point you can see is going to start really moving up. So in other words, the gap, I mean, look how small the range is, but the 4-week range is really, really low. Like we are, you saw the bandwidth is really, really low. We are squeezing, like we are really, the volatility is really tightening up, and we're setting up for a squeeze, a breakout of that volatility. And you see that in, again, we are below the point of control for the 4 weeks. We did get a lower high and a higher low point. So we basically an inside day. But again, we made a foray finally for the first time into the lower half of the 4-week range, and for that matter into the bearish part of 4-week range. It's only the second time we've been below the midpoint of the chart. The last time it only lasted a day. This time it's only lasted a day. We're actually back in the bullish territory after one single day. So again, let's see if we break back above 80 on Monday or Tuesday, then we're good to go, right? If we get back below the midpoint of the chart like the Dow Jones is, then that's not, like, you can see how bearish that is. We are clearly in bearish territory. In fact, the average is about to break out. If you look at the 4-week range on this chart, we have not got a new low point yet, but that's how close we are to a new low point. So it's just going to be one more day, and then that's going to be the low point. So it won't be at 100 unless we get a new low point on Friday, but it'll be really, really close to 100. And then it'll be a matter of whether it's just a one touch or not. Remember, the one touches of the red line up at the top are really bullish, right? If you get up to 100 and then you don't get any more, just like the one touches are pretty bearish when you get the one touches on the green side, and then you don't get any more and you come right back down. So you need to come up and be more than just a one touch. They tend to be pretty bullish when you just get the one touches there. But you are going to get a jump up above, at least above 70. You're going to be up there to, let's see here, you're going to be probably up to 89 on Monday when this rolls over and this low point comes over here. So this will be, the third, you'll have this day, the second day, and then the third day is at 89. So you'll be close to 100. And again, if we get a new low point on Monday, then which is likely, it's not 100%. But it is more likely than not, because of how close we are to it, obviously. Then that will spark the spike up to 100, and that typically starts intermediate declines when you start off with that. If you take a look at today's the volume and the range have been picking up. You can see the range really picked up on the S&P. It's not back above 1% yet. That's when intermediate declines start. But again, big jump up from where we were, and the volume had been already gradually moving anyway. So things, again, that's not, volatility has been picking up, and that's not bullish when volatility picks up. And you see that on the VIX. The VIX actually got up to 16. In fact, closed the week above 16 for the first time in weeks, right? Since way over here, we closed below 15. So it'd be back in October of 2023 is the last time we closed the week above. You can see the VVIX. Remember, before I left on vacation, we talked about the VVIX being extremely low, setting up for a spike. Well, there's your spike, right? Now we're up above 90 again on the VVIX, and you can see the VIX went along with it. So we talked about that going into the holiday, and we got it during the holiday. The jump in volatility, you can see we did jump up to the 95th percentile. We didn't get above it. But we did jump back up above it this time, unlike the last time where we didn't, get above 16. This time we did close above 16 again for the first time on a daily basis in a while. That close was at 1585. So this is our first time closing above 16 on a daily basis, much less a weekly basis. So you can see, and not only that, but the VIX also closed above the 200-day moving average clearly this time. So last time it got above it, went straight back down. 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 This time, not going straight back down. So there's a clear change in volatility. Like there's a new regime. You're above the 50-week moving average of the VIX. This is when this happens, you tend to get a clear change in volatility, which again coincides with intermediate decline. So we may, over the course of this past week, especially on Thursday, we may be seeing the beginning stages of intermediate decline here. Obviously, we're so complacent, the volatility is so low that we weren't going to have like a COVID type drop, or even for that matter, a banking crisis type drop, right? The volatility is so low and volumes and ranges are so low that the beginning of this intermediate decline was going to be, it was going to occur in stages, and it wasn't just going to happen all at once. We weren't just going to fall off a cliff. Like, what do they say? You go up the stairs and you fall out the window. We weren't going to fall out the window. It appeared that we fell out the window on Thursday, but in reality, when you put it in context of this months-long move that we've been on, Thursday's move, in fact, if you look at the zigzag here, because we've been looking at the zigzag, right? And you, again, go to 2%, and you say, okay, well, did we finally get to 2%? No, we didn't. Well, we did. We are now, sorry, we did. Maybe I was looking at something else. We did get to 2.04%. So we barely got our first 2% decline on a closing basis after setting the record, not in terms of length, we've gone longer periods, but in terms of size of the move without a 2% decline. Going 27% is the longest we've ever had. So we finally got a 2% decline. If you look at your Dow Jones Industrial Average, we dropped 3%. Now, finally, again, we didn't have a 2% decline. This entire time we went 23% without one. Now we have fallen 3% on the Dow. So you can see, again, how it appears that we are in these beginning stages of decline. Now, some of these other moves that we've gone so strong, that was the extent of the 2% decline. It was like barely more than 2%. We bounced back up for another 3, 4, 5%. So don't be surprised if we don't bounce back up here on Monday, because that's the precedent. And we go up for another maybe 2, 3, 4% up to new highs. Probably won't be strong new highs, but back up to these highs, maybe slightly higher, to get another 3, 4, 5% move before we finally get the actual. And remember, it's going to occur in stages because of how small how low the volatility is. It's not going to fall out the window, right? Consider it like falling out the maybe you fell out the window, but you just landed on a ledge, and now you're getting back inside the window before the fall out the window occurs later, right? But you're gonna fall off at the window onto a ledge, then you're gonna fall off the ledge onto the roof, and then the roof you're gonna fall off the roof onto another level, and then you're gonna fall off that level onto the ground, right? So it's not gonna be like we've seen in the past when volatility typically already is higher. By the time we actually do fall out the window, metaphorically speaking. Now let's take a look at what's driving this price action this past week. And you can see gold is now the biggest winner over the past 3 months. Has now eclipsed the Qs and the S&P as the biggest driver of this, up 13%. Really taken off kind of in the middle of this period. If I were to go back actually let's go to the rate of change chart and pull up gold. And you can see really this is where it took off on basically March 1st. We ramped up to the upside. So that is a 25 days. So if you look at, whoops, no, we don't want that. If you look at 25 days, I don't even know what that is. What is that? Chart describer, huh? If I go to 25 days here, so not 26, but just the 1 day less, so 25. Apply that. So again, you can see it's a pretty sizable move, over 13.5%. If I were to zoom out over 20 years, again, it's not the biggest move, but it's pretty darn close. So 13.64. You can see pretty darn close. Like we had, that move there in 2022 when the kind of at the initial stages of that intermediate decline. And then gold fell actually even though stocks were rallying into that October low point, or gold fell along with stocks, excuse me, as we fell to that October low point. So after that first stage higher, and then you can see we also had a big run of about this amount there in August of 2020, and then coming off of the COVID lows there in April of 2020. So big moves, and then those ended up being the peaks for gold. You can see other periods here that ended up being the peak in early 2016, 2011 during the beginning stages of that correction, there in 2009, right before the 2010 correction that occurred later there, and then coming off of the lows in 2009. The markets, gold rallied along with as we went to the lows in 2009. Gold was taken off along with like the dollar, and it also rose at the beginning stages of that correction 2008 about this amount. So you can see in 2006, right before the Fed was done raising rates, it peaked. Obviously, the Fed is way done raising rates, and now it's finally peaking. It did have a pretty decent run here in 2023, but now that the Fed is done raising rates, we've had a tremendous run up to the upside. If we were to go to April 14th, you can kind of see there's a little bit more of a run, but really that's where it broke out and has been up. So a pretty sizable move in gold, very parabolic. In fact, if you look at the DMI, which is what we kind of use to measure parabolic moves, you look at its ADX is well above 50. So like that again, it's been a long time since gold has had a ADX up this high. Like back over here in 2022, the ADX didn't get above 50. Over here in 2020, it did barely got above 50 there, got up to 51. We're at 52 right now, and showing no signs of letting up. Like you finally have the orange arrows down here with the negative DMI falling, or negative directional index falling down below 10, and you can see over here too. You came pretty close to 50 with some very high levels of the positive directional index, and there's a drop of the increase of the ADX up to nearly 50 on a negative decline. So again, you can see how it's not very common. It's a very, very parabolic move. Gold has taken off, and again, gold has really peaked. Like it doesn't really go sideways after these parabolic moves. It tends to really peak and start to decline. And again, beginning stages of a correction. Here coming off of in this early stages of a correction here, especially. Coming off of that correction, though, you can see the strong move we had going into the correction there, right before the COVID decline, and of course, coming off of the 2018 correction lows, you had a big move higher, along with stocks there in 2019 when we had the Fed rate cuts, notably the mid-cycle adjustment. So a big move higher. So you think, okay, well that probably means the dollar is having a big move to the downside. Not the case. I mean, there was a pretty decent drop this week, but again, down to the 17-day moving average, and so far holding the decline at the 17-day moving average. So we haven't really broken down. It's just, as of right now, would be considered a near-term decline. When you look at the market forecast for the dollar index, it's a near-term decline here. Light pink shading, but the intermediate line is still above market sentiment. The near-term line is down, but now it's been oversold and is bouncing back up, and we'll see how far it bounces back up. With the near-term line there, with the intermediate line now between the reversal zones, so across up above the intermediate line is what we'd be looking for a renewed bullish move. And of course, remember, equities don't do too well when the dollar is on a decline, generally speaking. Let's look at commodities. Commodities is the other big driver of risk aversion or risk appetite, and commodities are really moving higher. As you can see, this has been a huge week, one of our bigger weeks that you've seen. If you look on the weekly chart here, we got a bear tag on the weekly chart, which means we've closed up above, and generally these either will be start new legs lower in commodities, which is probably unlikely right now, or they start new intermediate moves up to the upside. On a long-term basis, which is probably more likely right now. So a very significant move on commodities. You can see a big reason for that is what's happening here with crude oil prices. Let's go back to crude oil. Here you can see a very strong intermediate trend. It broke out this week, really clearing up above these moving averages. It had been kind of grinding higher with small moves. But you got above the value area, so now you're above the one-year value area. The 50-day is about to cross the 200 days, so you're about to get a golden cross on those long-term moving averages. Of course, you're a little overbought in the very short term, so you're probably going to get a drop back to the 8 and maybe the 17-day But obviously we have clearly established a bullish trend up near $90. Again, that's generally not bullish. Has not been over the past few years bullish for risk appetite to see this decline. Now, generally when we've been up here, we've already been in intermediate decline. So, well, if I go back out here 5 years, you can see that intermediate decline we had last summer, late last summer, and then you can see at the beginning stages of this correction. By the time we got to these levels, remember, we're not in an intermediate decline right now. In fact, we are still very, very strongly bullish, and the likelihood is that we'll at least probably bounce up for at least one more near-term leg higher, at least. Now, granted, we'll see if it ends up being a bullish leg higher, or if we start getting some bearish peaks again, and that kind of signal that we're towards the end stages of this bullish rally. All right, now let's take a look at our trade idea of the day, and let's take a look at Okta. Okta, you can see, has gotten a bull tag here recently last week on Wednesday. Fell down with everything on Thursday, kind of followed through on the bull tag, and a little bit of a bounce up, still below the moving average. The intermediate line had crossed below its market sentiment between the reversal zones. The near-term line is obviously well below. The intermediate line has been for a while. Obviously, it crossed below it, it crossed below it here, between the reversal zones as well, and has been below it this entire time. So, post earnings, it hasn't really followed through on that. Earnings has been kind of weak since then. If you look at its weekly chart, you can see we finally got a bearish candle this week, so we crossed the below zero down here. Not very big, not the biggest, but we had some big old bullish candles here, and we didn't, again, weren't able to follow through on that. When you look at the 3 green arrow, you can see we obviously have 3 red arrows. MACD is red, has been for a while, so Cal6 is in the reversal zone. Now we are below the moving average, and we notice there's a big old gap in volume here because of the earnings. So we are into the post-earnings gap, and there's not very much move until you get down to about 91, where you reach these old peaks, some resistance levels, and that's where the next layer of resistance support is, and by then you'd be well between the 50 and 200-day moving averages. So an opportunity for some to take advantage of weakness on the stock. If you look at its DMI, you can see both these lines are right around 25, though you do have, the ADX is falling back down, and your negative is slightly above the positive. When you look at the RSI and the CCI, you can see when we were once bullish, now we are at pretty strong bearish levels. Got below minus 200 there, got below, now we are below 50. Didn't get below minus 40 or below 40 yet, but we are still in the lower half of that chart there. Looking at the trend chart, again, we had a strong trend because of the earnings. It produced a very mature trend very fast, but now that trend is gone. We've crossed below the blue line. The green line's crossed below the blue line, and now you can see where the next stage would be to move towards a cloud, or potentially through the cloud, as there's not really very much of a cloud at that point. And that's how close we are. We still have a positive rate of change, very positive rate of change, but we are one day away from having a pretty negative rate of change. So that's how fast things can change on that chart. So you can see how things are turning bearish. So let's one more. Let's look at the Bollinger Bands and the Keltner channels on this. You can see we are in the lower half of the Bollinger Bandwidth. The band, you can see that gap in volume there. The bandwidth has really come down after that post-earnings spike inside the Keltner channels on this negative momentum. You would expect that we'll break out of this if we continue to push against that lower band, especially if we break below the lower Keltner channel. So we'll kind of keep our eyes on that. So not the strongest bearish trade yet, but an opportunity here to do a bearish trade. So what I decided to do was to sell the 105, call, and buy the 110. So let's do a bear call spread. That sets me up for this trade. If I were to position size for a full position, so just over $1,000, getting a pretty decent return. And then that break even you see is right up here. So you can see if we were to clear that break even, which is this volume node, there's gonna be some resistance there. You're gonna be back above the 30-day. The 8 and 17-day will be back to being bullish. So we'll be clearly bullish by that point, and I'd be willing to take a $435 loss, because that's what we're shooting for. Of course, the odds suggest that would be less likely, that we're probably going to end up staying down here. If you look at it on this chart, that would be a clear reversal, right? We'd be back in the upper half of the chart, as we've been in the lower half. If you look at this chart here, we've been in the lower half now. In fact, the average is about to cross into the lower half, so we're pretty clearly bearish. we'd be back into the upper half and back above the moving average. So we'd be clearly bullish if we were to get back up to that level, and we don't want to be in that. We can take whatever loss we have at that point and be out of the trade. So I like that setup. So we'll just confirm and send that through for Monday's open and see if it fills in. All right, well, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.